Ladies and gentlemen, welcome to our panel, Economic Freedom and Financial Innovation, America's Competitive Edge in a Changing World of Trade, Tariffs, and Technology. Please welcome to the stage Mr. Greg Ip of the Wall Street Journal and our distinguished panelists.
Thank you, everybody. Thank you to the Reagan Institute. Thank you to the Reagan National Economic Forum for putting on this very interesting and terrific and timely event. So economic freedom, of course, was sort of essential to Ronald Reagan's view of what was important to America and to delivering for Americans. I mean, the chain of events is basically economic freedom leads to more innovation, leads to more entrepreneurship, and that leads to economic growth, and that lifts the whole country. And on this panel, we'll be talking mostly about finance, but it's important to always remember that finance is a handmaiden to the real economy, and it plays a crucial role because it is a financial system that connects savers, the people with capital, to the entrepreneurs and the innovators, the people who need capital. And one of the reasons the United States has always been the economic leader it is because its financial system and its markets have always been among the most innovative and advanced, and the current period is, like other periods, one of just enormous ferment and innovation. The big one, of course, digital currency and crypto, but also artificial intelligence applications, venture capital, private equity. We heard earlier about the fact that the United States boasts far more valuable tech companies than Europe does, and one of the reasons is because our financial system makes those companies possible. Here to talk about what the next steps are in those things and the challenges we need to confront in making sure that innovative edge remains. We have a great panel today. Starting with my immediate right, French Hill represents the 2nd District of Arkansas. He's also chairman of the House Financial Services Committee. Very key role right now in a lot of important legislation covering digital and other such technologies. Faryar Shirzad, Chief Policy Officer at Coinbase, the largest, best known, and I think only publicly traded crypto or digital platform in the United States. Before that, he was with Goldman Sachs. My far right, Kevin Warsh, somebody I've known for many years. He's a scholar at the Hoover Institution. He teaches at Stanford. He's a partner of one of the most legendary hedge fund managers, Stan Druckenmiller. And from 2006 to 2011, he was governor of the Federal Reserve at one of the most tumultuous times of the economy. So a really great panel to talk today. Faryar, I'm going to start with you because I think the first question I want to ask about crypto is the kind of question I think a lot of ordinary Americans ask. I've heard about this thing now for 17, 18 years, but it hasn't changed my life yet. Where are a lot of people are trading it. I keep talking about it, but when I go to buy stuff, I'm still not using it, right? I mean, in fact, a survey from the Fed just came out last week. Only 2% of American households used it for any kind of payment last year, and that's actually not that different from 3 or 4 years before that. So I think the question on a lot of folks' mind, on my mind, is why no transformative applications yet, the way, say, ChatGPT has come along? What are we waiting for? When will that happen? Tell me what amazing products digital and crypto will make possible 10 years from now.
It's a really, really good question. So the technology is only about, let's say, 13 years old, and it came about in a technological breakthrough to solve something that the internet did not solve. What the internet did is it democratized the ability of people to move data back and forth on a peer-to-peer basis using a decentralized, loosely governed protocol that intermediated the ability of people to move data. What the internet did not allow people to do was to move a unique digital token, a thing of value, so that you could execute financial transactions using the same seamless technology of the internet. Crypto is the breakthrough that allows you to do that, and so the potential for it is enormous for payments, as you're saying. I think there's 2 reasons why the adoption has not been at a scale that a lot of us expect to happen. One is there's 3 things that you have to have a scaled payment solution on the blockchain. One is you have to have security, you have to have scalability, and you have to have speed. That trilemma of crypto transactions has only really been solved over the last couple of years. The ability to scale, where you can do millions of transactions a second on a scale that's worthy of the largest payment processors. And that's why even over the last year and a half, 2 years, you've seen Visa has integrated crypto technology into their payment system. PayPal is now using crypto-based payments in their payment system. And you're seeing JP Morgan is executing corporate transfers using blockchain technology. So the technology is now caught up. The other part where Chairman Hill most authoritatively can speak to is the lack of regulatory clarity. There's in this question of, are the transactions executed on the blockchain eligible for the most regulated activities? And the chairman can talk about this. There's stablecoin legislation that's working its way through the Senate. The House has a corollary. The Senate version, at least, specifically speaks to some of the most highly regulated payments activities, allowing them to be executed with stablecoins. So, collateral management for derivatives transactions, for example, used for bank capital purposes and the like. So we're getting regulatory clarity. The technology's caught up. There's broader adoption, and I think we'll see that we're at a tipping point.
Chairman Hill, can you speak to the regulatory clarity issue? In fact, that happens to be the name of a bill that you, I believe, just introduced this week. To what extent has the absence of regulatory certainty, describe the landscape of what that's like right now. To what extent has that held back the industry in this country?
You bet. Happy to do it. Glad to be here. I started my political career when President Reagan was in his first term and worked on the Senate Banking Committee for John Tower from Texas. And so President Reagan's always been a tremendous influence on my life, and it's a pleasure to be here at the library. Well, first, let me comment on the adoption issue for a minute, because I think that's an important one. You know, John Boehner famously said the House moves very slowly until it doesn't, and I see Speaker Ryan back there, so he knows about that. But that's also true in that tipping point in technology. I mean, people have worked on this concept for a long time, and just because you see ChatGPT in 1 month outstrip the rate of growth of all cell phone users doesn't mean that people haven't been attempting to pioneer that technology for decades. It just hits that point, and that's why I think your suggestion that we're now reaching that point of economy of scale, that tipping point of the technology where it can show both business and consumer applications. So let me address the regulatory front. To have a new payment rail on a blockchain, and you have to think about a blockchain as simply an operating system. Boskin and I learned how to program in Fortran, so that was an operating system back on a college campus 40 years ago. But we went to DOS, we went to Microsoft, we went to Macintosh. These were operating systems, and people wrote applications for them to solve solutions, right? Lower cost, faster, more accurate. A blockchain operating system it's an operating system. And what he's describing is people are now writing applications on them that increase the speed, increase the accuracy, increase the ability to reach different niche solutions, whether it's a consumer household solution or a commercial solution. And we're seeing that now, and you named some great examples. So I believe that a dollar-backed payment stable coin will be a new payment rail in global society. It's there now significantly outside the United States, but I think you'll see it adopted, particularly in a Web3, web-based environment. So I don't plan on going to CVS and use it personally, but it certainly might be there at that point of sale, brought to you by a stablecoin issuer or by a merchant or by a consortium, just like you can write a check today, pay in cash, use a debit card, a credit card, send an ACH, call your bank to send a wire transfer. This will be a blockchain-based payment rail, and that tokenized payment will be a dollar-backed stablecoin for commercial purposes or for retail purposes, and I think you'll see its adoption. Why do we not have it? We don't have a law to permit it. New York authorizes the creation of a stable coin, but it's not adopted across the ecosystem. It's not accepted at banks. You've had 4 years of the Biden administration that showed crypto and payment stable coins and blockchain advance the Heisman. They said, we're not doing it. We're not going to advance it in any way, shape, or form. But in Congress for 5 years, we have advanced regulatory framework for a dollar-backed stablecoin with high standards, and for the market framework, which would be, how do you custody a digital asset? How do you own it in a self-custodied wallet? How do you exchange it with someone else? How is it taxed? How is it held? Who regulates it? And that's what these two bills do. They're both introduced in the House, and both the House and the Senate have a stablecoin text. My college pal from Vanderbilt, Bill Hagerty, carries the Genius Act in the Senate, which is a dollar-backed stablecoin bill. And Brian Stile, who's in the audience today from Wisconsin, has the Stable Act in the House, which is a stablecoin bill that's dramatically similar in scope.
So how long, once these, and I'd point out that you have significant cross-the-aisle sponsorship on both those bills, right? So
We do. Both are bipartisan.
presumably, once those bills become law, how long before we start seeing that causing things to happen in the industry? What are people like sitting there like just champing at the bit ready to do?
Well, first, I think private business, whether you're Jamie Dimon, who has an army of people programming in this space inside JPM, or a great startup in Menlo Park, they will now both have the rules of the road. And we're going to have presumed regulatory authority for people to experiment and start to advance that with some safe harbor process while those rules are written. But because I think New York has successfully authorized dollar-backed stablecoins, I think you'll see that relatively adopted by bank and non-bank participants under the rules over the course of a year or so. And I think that market framework will settle in probably in a little bit longer time on that. But you ought to ask Farrar for his view on that too.
Yeah, I mean, the other thing I was going to say is to remember, we're just coming off of 4 years of an administration who was at war with the industry. And so think about it, the banks were put under enormous pressure. Jamie Dimon actually talks about this quite publicly, to debank crypto companies.
Yeah.
Even members of my own team couldn't get mortgages, home equity loans, auto loans, because they were being squeezed out under political pressure from the Biden administration. So the investment in the technology is happening. It's a kind of a crazy thing to have had a giant 4-year battle over. It's just an information technology solution. The adoption of it is going to occur rapidly, particularly as Congress moves to provide clarity, and you don't have an administration that's trying to destroy the sector.
Kevin, I want to turn to you. There has been a lot of talk over the years that, well, you know, why should we not have a digital dollar, right? Should the central bank issue a digital currency to circulate alongside the dollars that we hold in our wallets? And people have advanced a variety of arguments why this would be democratizing and so on. Other countries, China most notably, have done that. What's your view? Should the Federal Reserve get into the game of issuing a digital dollar? And if not, what is the Fed's appropriate role in this space?
So in a word, no. In several words, first, it's an honor to be here. I always wondered what the shining city on the hill looked like, and it's pretty cool to see it once from my own eyes. For French, this is a little old home week because he served at the time that the president was in office. For most of us who came into government, guys like Farrar and me and some in the crowd, you know, Reagan was our hero when we were kids, and I would say, and for many of us, we wouldn't be here, we wouldn't be in public policy without his example. Right. I'll say one other thing that I promised I'll come back with a longer answer than no to Greg's question. This is our Reagan moment. It was 44 years ago at a time like this. President's in office, the media's giving him hell. He's shaking up the establishment. He inherits a mess. People don't like what he's doing. There's some gauzy history about how easy it was. French can speak to it better than I. It wasn't easy. And this is that moment. This is that hinge point in history that we see every couple of generations. Doesn't make it going to be easy. Doesn't mean that every decision's obvious, but it's super exciting. So that's my thank you to the Reagan folks. On Greg's question, the idea of a central bank digital currency works well for the CCP who want a 5-year plan to control their people. I think it's ahistorical and frankly anti-American. The central bank has plenty of responsibilities in the United States. I, for one, would like them to be a narrowly focused central bank, making sure that we have stable prices as a condition precedent to full employment, not wandering into other areas. And there was some impetus for the central bank here and in some other Western countries to establish this. I can think of few things more dangerous than if 300 million Americans had the equivalent of a wallet at the Federal Reserve. The next crisis happens, Congress acts slowly, lobbyists come to Washington, and a bunch of politicians say, well, we really can't fill those wallets. Why don't you guys just do it? This is against the grain of our constitutional republic. I would have to think that Ronald Reagan himself would be outraged by it. And the privacy that in America we take seriously would then be called into question with the central bank policing all these accounts. Another problem, of course, with it is in the US, the strength of the economy is our private sector. We don't need the central bank crowding into that anymore. I'll just say one final point. I think Farrier and Chairman Hill did the right way of describing this. Cryptocurrency in Washington and much of the country sounds very scary. Whoever named it that, I think, deserves demerits. Crypto somehow means secret, and currency suggests it's money. Well, what a misnomer. It's software. The coolest, neatest software that every 16-year-old on the planet wants to do all their work in. Software can be used for good things and bad things. I don't blame Excel if a spreadsheet is being used by a bunch of gangs, do I? It's important, as French describes, that there be a clear regulatory framework so this software can find its way into the economy. And as a final point, I would say we're probably on the front end of the use cases that Greg asked about. In the future, probably not that far from now, a year and a half from now, we're all going to have these devices in our pockets like we do, but they're going to be our agents, and they're going to go off and check in on our flights and see what the traffic's like and make sure the Uber's here to get us without a single instruction by us. The only thing it doesn't right now have the capacity to do is actually verify that I am that person, that agent is my agent. Well, that use case is being made possible by the people sitting next to me. This technology was pioneered in the United States, like AI, like much of the productivity boom that allowed the 80s and 90s to be there. I think we're on the cusp of another productivity boom, as long as our government doesn't do harm to it, and as long as the central bank doesn't say, well, enough of this private sector, we'll do it for you.
You've written that while the Fed should not be issuing a consumer currency, it has a role to play in perhaps the issuance or management of a wholesale digital currency. Can you elaborate on that? How is that different?
Yeah, so it's radically different. The banks do their business with the central bank. Households and businesses do their business with the U.S. commercial banking system and a bunch of what we call unregulated financial institutions. That's the two-tier system that is, I'd say, fits the American Republic exceptionally well. But the Fed does have a lot of plumbing that we do in making sure that the conduct of monetary policy, those pipes work, that the infrastructure in the treasury markets work, and that's what I think of as wholesale rails. Well, those wholesale rails that our government has been using were created in the last century, are not done instantaneously. Payments still take days, often weeks. They're not verifiable. They're subject to massive breakdowns. They're not secured, and we can't be perfectly certain exactly whether the counterparty is who we think it is. Well, that's where the new software comes in. I do think there's an important role for the Federal Reserve to help outline what the new architecture should look like, and to allow the private sector to build a wholesale new infrastructure using the coolest new software. And it's not just for little gains of efficiency. If you believe what I believe, and I suspect my colleagues up here believe, which is we want the dollar to continue to be the world's reserve currency, I believe our economy will be worthy of that over the course of the next decade and two. And we need to have the best infrastructure, so this is the place where people feel most comfortable conducting their transactions, not just between the banking sector and the government, but that's the backbone then for the rest of the private sector.
I want to actually, I don't know if this is where you were going to go, Chairman Hill, but I actually want to bring the discussion of regulation back to the consumer, right? Because it's kind of like the cycles of history. The innovation races ahead, and there invariably are abuses and sad stories of people whose lives were damaged because it went further than it should have. I mean, you could talk about subprime lending, for example, which was supposed to democratize mortgages, but it ended up causing a lot of harm. You could go back to like online stock trading and whatever. So certainly you could sort of imagine a scenario where the digital industry also races ahead of the ability to protect people. And when people nowadays, I think, hear about crypto, they also hear about like ransomware. They hear about the anonymity of it. It's impossible to find out like who stole your money or where that thing is. What, Chairman Hill, talk to me about how we address that piece of it, and especially in an environment where the current administration has like taken a very kind of reductionist view on the role of consumer protection by significantly shrinking the Consumer Financial Protection Bureau.
I'll come to that, but let me just add on to two good points that Kevin made on the wholesale application. Just two quick comments. On a distributed ledger technology, it's ideal in settling accurately and timely large activities that are over the counter, so small volume but big numbers kind of a settlement. So in between banks, central bank settlement on a blockchain settled in dollars in a tokenized payment, I think is absolutely part of the future. I don't call that a central bank digital currency any more than Saudi Aramco, one of the biggest public companies in the world, has their AR, accounts receivable now, on a blockchain. They shrunk their accounts receivable days from 40 to 15 over time by creating smart contracts on a distributed ledger that's validated, and those payments are made in a dollar-backed stablecoin mechanism. And so I think you will see wholesale application, and I just don't connect it with a retail CBDC, which the Congress on a bipartisan basis does not support. In Article 1, we control how the money is issued, and it's not going to be issued in a CBDC, FYI. And we thank Tom Emmer of Minnesota for carrying that legislation in the House. Now, on to the consumer point, because it's a good one. Two things. One, first of all, just consumer protection generally. I'm experimenting in this thing called crypto, and I have an account at Coinbase or some other entity. And what are the disclosures? How do I know what I'm buying? How do I know that it's not just a meme coin thing versus a utility coin versus something that has future application? How do I tell the difference between one blockchain versus another on speed? So I think with a regulatory framework, you pick up that, you standardize that disclosure. We have a disclosure-based society in finance generally, and that will improve by virtue of both the stablecoin definition as well as the market framework set of definitions for consumers. On the terror finance risk or the illicit use of a blockchain, I would remind everybody, there's more illicit finance in the world using the $100 bills that we ship by pallets from the Treasury over to the central banks in the Middle East and other places than almost any other. Then trade-based money laundering, counterfeit cigarettes would be a top example of that. Oil, obviously you read about in the paper every day. And then hawala in the Middle East. These are all forms of illicit finance that somehow people don't. They assert that if you use a payment on a blockchain that you're financing the North Korean nuclear weapons program. You read that every day. Why is that? Because the North Koreans are massive hackers on this very informal system that we have out there that isn't very well regulated and overseen. I'm arguing you have a strict standard set by the United States of a stable coin and a market framework. You diminish that identity theft, that wallet theft, that cyber hacking dramatically. You raise those standards and you reduce North Korea's capability of doing that. And then we have Anti-Money Laundering and Bank Secrecy Act laws that we're supposed to obey as individuals, as business owners, and they'll apply to people out on the blockchain as well. You mentioned the CFPB. It's not about reducing consumer protection. The Trump administration is not for reducing consumer protection. The Trump administration, like I hope all administrations, is for robust consumer protection of Americans. This is about having the CFPB, the Consumer Financial Protection Bureau, stay in its lane, its statutory lane, stay focused on what it was created for, not be duplicitous, not be redundant to all the bank regulations that we already have. And so it's more narrowing the scope, focusing the entity, making sure it's following its statutory obligations and not out as a political arm of the Democratic Party.
Chairman Hill, I'm going to hold on to you just for 1 second because I do have to ask you this, of course. I mean, this administration has been very supportive of crypto. President Trump was very supportive of it. He had a lot of support from the industry users. Now you have a situation where he and his family are also becoming very personally involved, you know, where Trump's company is about to raise money to buy Bitcoin, where the Trump family, where the Trump family wants to do that, where Trump himself has sponsored his own meme coins and invited buyers of that coin to meet with him. This obviously raises a lot of questions. People on the other side of the aisle have complained about this on your own committee. Does the president and his family's level of personal interest and investment in this, in crypto, create a problem, either a perception problem or a political support problem?
Well, look, we've worked for 5 years in the House, particularly, to have strong bipartisan support for stable coins and a market framework. And in 2023, we got 71 Democrats to vote with the House Republicans to advance the market framework bill, the predecessor to what we introduced yesterday. So our members in the House and Senate have done their homework on both these issues. They're pro-innovation. They want to bring these jobs back to the U.S., the investment back to the U.S., We want the U.S. to lead in this aspect of fintech, financial technology, and I think we have a bipartisan consensus on that. With that said, and it's absolutely fact, and I've witnessed it, as has Brian Stile, my subcommittee chair on digital assets, for sure, in the House. The Trump family engagement in the meme coin world, has made this work more complicated because it has distracted, I think, our members, both Republican and Democrat, from what we need to do. And if you're concerned about meme coins and whether they have no value or what the purpose of them is in society is, then you need to help me pass a stablecoin bill and a market framework bill that will lay out these rules of the road quite clearly as to how digital assets work in our economy and how they will have utility and the ones that won't. And just like in our public markets today, I don't recommend that you buy a junior gold mining over-the-counter stock that is thinly traded, that's traded on an exchange outside the U.S. with companies that don't report quarterly and have weak, information. Weak disclosure, right? That'd be a risky, maybe it's under $5 a share, maybe it's a penny stock, but it is out there and you may buy it, right? In a highly regulated market. So when we have a more developed market, there'll be more information. I think people will have the information they need to make good decisions about digital assets. And that's why these rules are important. But yes, that engagement has made our work more complicated because it distracts our members from the goal that I have which is promoting American innovation.
Faryar, a few weeks ago, your company, unfortunately, was the subject of a hack and created a lot of hardship for your company reputationally and for your customers. How did that happen, and how can you assure all the people who've heard about that and hear about all the excitement about crypto, how are you going to prevent that from happening again and hurting me? And what are the larger lessons for the people on this panel in this room about how we prevent stuff like that happening?
Yeah, it was a really unfortunate incident. We had a customer service center in India where a number of our employees were compromised by a criminal gang, and they had access to personal identifier information about some of our clients. It ultimately affected, I think, less than 1% of our monthly transacting users, so it was a relatively small number. What they were not able to do was to touch the blockchain-based system that we operate. So no client assets were touched, no funds were taken, nothing of that sort happened. So it was a very bad situation. We immediately disclosed it. We were actually subject to a ransom demand by the folks who said that they wouldn't, that if we paid a ransom, they would hold the information back. In the end, we obviously went to law enforcement. We're working closely with DOJ to deal with it. So I think it's a problem where we feel pretty good about the systems we had in place, but we're tightening them up. We're shutting that particular center down. But it doesn't raise anything in particular about crypto because the crypto assets we're protected. We have the most impregnable system of anybody in the industry. Coinbase is the world's largest crypto custodian. Something like 15% of all crypto is custodied by Coinbase under a New York Department of Financial Services regulated entity. So there are lessons there, but I think we have to be careful not to overlearn the lessons from a bad situation.
Kevin, let me come back to you because I want to pick up on a point that you made in the earlier remarks, and it's a point you've made often, including at your remarks for at the International Monetary Fund a month or so ago. And you talked about essentially the Fed's, I was going to call it the mission creep, but in your view, it's more of like a mission race or a mission expansion. Is like this vast multiplication of Fed responsibilities and facilities and so forth is a problem. I think you've talked about it crowding out private sector activity, and you referred to the Fed's balance sheet as, in some sense, a proxy for the imprimatur of the Federal Reserve on the private economy. It's around $7 trillion, a consequence of quantitative easing, a program that began when you were on the Board of Governors. Do you believe that the Federal Reserve, through that mechanism specifically, but in general, is posing a serious financial freedom and stability risk to the economy? And what should be done about it? I mean, what do we do about that giant balance sheet? What should the Fed do?
Sure. So when I joined the Fed in 2006, I remember calling my dad and telling him I was going to do that. And first thing he said is, so you couldn't get a job in the private sector, could you? I grew up in a small town, and the only thing he knew, he was a small town businessman, reasonably successful. He said, oh, that's the thing that Greenspan runs. So he knew about that until the global financial crisis in 2008. From the darkest days of that crisis, where we went, as Chairman Volcker said, to the very edge of our powers to try to save the republic from a massive depression, and we got very aggressive, and in my view, rightfully so. The central bank was created in 1913 to respond to panics, much more so than to mess around with interest rates. So it was aggressive moves. But from that moment, really, until this day, the central bank has stayed on the front pages. Instead of going on the front pages when the crisis hits in 2008 or the pandemic hits in 2020, the central bank has become the most important economic institution in the world every day for all seasons and all reasons. It wasn't that long ago that we would read about the central bank in an article Greg Ip would write a couple of his jobs ago. Today, the Federal Reserve met as they do every 6 weeks, and they raised rates a quarter or cut them a quarter, and it wasn't in everyone's lives. The central bank has now decided, probably with the best of intentions, that they are going to play a more permanent role in the economy, in the business of banking, and I would also argue in the fiscal business of the country. I'll use an example of that to tell the balance sheet story. In 2008, in the darkest days of the financial crisis, as people in this room will remember, the markets were down 60, 70%. The real economy was running away from us. If the US economy went down, the world was going to be in a bad place. So we were willing to take some risks. And we decided, after some major internal debate, we'd buy the bonds of our own government. Secretary Paulson was issuing bonds on Tuesday and Wednesday, and we'd buy them on Thursday and Friday. But we said to ourselves, when this crisis is over, we're not going to do this stuff again. This isn't what the most important economy in the world does, but we really never put that tool away. So the central bank's balance sheet today is an order of magnitude bigger than it was the day that I showed up. So part of the reason why Chairman Hill and his colleagues in the Congress have had to witness this massive surge in fiscal spending over the last 5 years, over the last 15, is your central bank was subsidizing the cost of it. We were showing up, not just in crises, but in times of relative peace and prosperity and buying the bonds, hiding, camouflaging the full cost of spending. As we sit here today, the statistic is as of January, our federal government is spending 60% more money than the day before COVID, 5 years ago. I hardly remember that being a time of like an efficient, austere government, and we're spending 60% more, borrowing that money from people, some of whom don't like us, at prices we probably can't afford for projects we don't need, in a time that we're at full employment. The central bank has made that possible, not from a bad place, but from a good place, and in some sense they've taken on these powers. This bigger central bank balance sheet crowds out the fiscal authorities, elected leaders like Chairman Hill, Treasury secretaries in governments, and has put them on the front pages. My view is we should be on the front pages when we're in real trouble. Otherwise, we should be back on page B12 of the newspaper. One final point. One of the consequences of this institutional drift into all sorts of business, climate policy and everything else, is the inflation that we've witnessed over the course of the last 5 years. Now, for most of us in the room, it hasn't been that big of a deal. We know it when we go to the grocery store, but we also own financial assets. Maybe we own some Bitcoin. 52% of our fellow Americans own no financial assets. They don't have equity in their house. They don't have an account at Schwab. They don't have an account at Coinbase. They're living off their W-2 income. And this surge in prices have destroyed them. Yeah. It's the most regressive tax any government could ever come up with. Imagine if we had a central bank that had been deadly focused on that. I think we wouldn't have taken a divided country and made it more divided. When we have a big balance sheet, we're asking for the inflation that came. And as a final point, my own judgment is the story that I hear from many of my peers. Well, the inflation, well, that's not really the central bank's fault. That's because of Putin and the pandemic. Nonsense. A change in prices happens in a market economy because of shocks in the world. Changes in prices happen every day. That's not what inflation is. Inflation is when that change in prices become embedded. It's second and third order effects. And that's what's been the biggest harm to the country. My recommendation is a smaller balance sheet, takes the Fed back to a more manageable size, a more serious job. And interestingly, if you can have a smaller balance sheet, you can have lower interest rates. Back to you.
How much smaller?
So when I joined, the Fed balance sheet was about $880 billion, included a bunch of foreign currencies. We do need some balance sheet to take to do our underlying business, to help run the treasuries, to help be a good counterparty to the rest of the central banks in the world. The economy's obviously grown since then. I wouldn't want to put a precise number on it, but right now the Fed balance sheet is about $7 trillion. They are participating in almost every banking market, almost every day. The world has come to rely on the central bank's massive imprimatur. I would say it is trillions larger than it needs to be. We can't make this change overnight. But if markets knew that our objective was to get to a balance sheet that was as riskless as possible and as small as possible, and we would get there in due time and with a strategy, I think markets and market participants could well adjust to it. The central bank could then be a powerful central bank, but a more limited one, and I would argue wouldn't find its way in harm's way politically or economically.
I have to ask you this, I will come to you because this is important too for the work you're doing, but you brought up politically at the end. How important is it that the Fed be independent in monetary policy? You've said operational independence, but does that mean, for example, that governors, including the chairman, should be free from the risk of being fired for other than cause?
See, Greg started out so softly, we're talking about crypto, and then you see the Fed beat reporter in him come out here at the end. I believe in the operational independence and the conduct of monetary policy as a political economy matter. I think the economy is better off if the world perceives, markets perceive, members of Congress perceive. You got central banks that are calling it the best they see it. Being a central banker is not a prize for the perfect. These are hard jobs, lots of uncertainty. The data is a mess. But the world's better off if they think they're doing their level best to call balls and strikes. But the operational conduct of monetary policy doesn't mean that the Fed shouldn't be criticized. Central bankers should not be pampered princes. If Chairman Hill and his colleagues think that we're doing a terrible job at the central bank, they should be able to call it out. Same thing with the president. As a matter of fact, I'd rather the president call out his consternation with the central bank to the world than do what used to happen in generations past. I don't mean to be invoking President Reagan again, but being summoned to the Oval Office for a little quiet to-do about what you're doing and right. Central banks were created so that politicians would have someone to blame for this. None of this is new. I read breathlessly in the newspapers how mean these politicians are to the central bank. Well, grow up, be tough. And here's the most important thing. What's the secret to central bank independence? Hitting its objectives, doing its job. Imagine we had had stable prices in the last 5 years like we did for most of the 30 years before it. Well, there wouldn't really be much of a political fight to be had. Doing its job and having stable prices is the Fed's plot armor. It is how we can succeed and thrive. I call it plot armor. I learned this from Mark Andreessen, who's going to be our lunchtime guest. He introduced the expression to me. I'm a big James Bond fan. I watch all the movies. But James has plot armor. We know they're never going to get him because we want to watch the next movie. The Fed's plot armor is being good at its job. And so my own judgment is the failings in its job, not just in achieving stable prices, but wandering into things in which they have no business, like climate, suggest that the politics are happening somewhat closer to home.
Chairman Hill, so I'm going to say that while Kevin appropriately points out that, you can't take the Fed reporter out of the guy, it matters to the big issues that we're talking about now. We all saw what happened to the financial markets when the president did threaten to fire the Fed, or said or intimated that the Fed chairman could be fired. So one of the reasons U.S. financial markets, I think, are perceived as a secure system as they are is a system of institutional predictability surrounding the Treasury and the Federal Reserve. And Kevin, I think you appropriately point out that it's incumbent upon those institutions to demonstrate that they are doing what has been asked of them. But Chairman Hill, I want you to weigh in here because your committee is looking at this issue right now, right? The way the Federal Reserve and the Treasury operate, right? Tell me a little bit about that. And please, if you will, address this question of how independent the Fed should continue to be.
Mm-hmm. Well, Kevin's outlined it quite well. The Congress created the Federal Reserve in 1913, and being independent, it doesn't mean you're immune from criticism. So let's leave it at that. I think the Fed chairman is independent of being fired by the president. I think the courts have indicated that.
Is that a good thing?
I think it's a perfectly fine thing, sure. But it didn't stop Lyndon Johnson, Richard Nixon, Jimmy Carter, and Ronald Reagan, all to have intensive sessions with their Fed chairman, some in public and some in private. I invite you to listen to LBJ's recordings about that, or read Amity Schlei's spectacular book about the Great Society, where she outlines Richard Nixon's attempt to fire Arthur Burns and putting Alan Greenspan, a young staffer, up to the trick of doing it. So this is, as Kevin says, part of history. But this issue of monetary policy since 2008 is of concern to the committee. Are we okay with it? Because when Kevin went on the board, the balance sheet of the Fed was about 6% of GDP. It's a quarter of GDP now. We've never really undone the balance sheet. We're not a Treasury-only balance sheet. We own mortgage-backed securities and a whole lot of other flotsam and jetsam from other crises. And we don't ever unwind it. So smaller balance sheet, I think, is a good wisdom on Kevin's part. So we formed a special task force chaired by Frank Lucas of Oklahoma to look at post-08 monetary policy. We pay interest on reserves now. We never did that before. We use the balance sheet like never before. We did not do that before in our, quote, targeting for short-term rates. We now are the line provider to all the central banks in the world. That used to be a private sector activity. That's now a public sector activity at the Fed. So we're going to look at that monetary policy structure, and they have their review of their inflation targeting that's being conducted by Chairman Powell right now. And you remember in August of 2020, in the middle of the pandemic, the Fed just announced one day in August, well, we're going to let inflation run ahead of the 2% forecast because we've never been able to get it to 2%. So that was part of their new monetary policy approach in the middle of the pandemic. So we're looking at that. Second part of it is to look at Treasury market structure. With sustained budget deficits into the future, what is the role of the Fed and the private sector in assuring that we have adequate Treasury auction space, the role of the primary dealers, the role of the private sector there as well. So those two pieces are important, and I think Frank is going to do a great job making recommendations to the Congress about what, if anything, we need to do regulatorily or statutorily about the Fed's role in monetary policy, how it's conducted, or what can we do to enhance Treasury market structure.
I do want to ask you a question.
If I could just say one thing. So I just wanted to say thank you to French and his colleagues on this. After 9/11, the American people demanded a what went wrong. After the 2008 financial crisis and all the harms that were done, the American people, elected representatives said, well, we got to get to the bottom of this. How did this happen? Let's connect the dots. Somehow, after the great inflation that served many of us well and did great harm to our fellow citizens, barely a peep. What are the fundamental reasons why this happened? Is it really because of Vladimir Putin and the pandemic, or is it something we could have controlled ourselves? It was a very quiet group. This group in the House of Representatives decided this deserves the same level of scrutiny. I think it's essential. I think it's important. I think it's not been done. And just to give another example, after the 2008 crisis, the Dodd-Frank Act was put in place because we were going to make sure we'd have fundamental reform of our banking supervision and regulation. That thing had been running for 15 years. All of our bank regulators said, great news, we've got a safe and sound banking system. Until February of 2023. Two relatively small banks, hardly ones that we thought were systemically significant, had a bit of a run. The regulators thought everything was just swell until they weren't. And we've never asked the question about, well, maybe all that Dodd-Frank legislation didn't work. Maybe our banking system is not safer and sounder. Maybe we've created less competition. And I think we got to get to the bottom of it. The more honest we are about what we're doing right and wrong, the more we can fix it. And if we don't fix these things, the 21st century will not be ours. It will be some adversary of ours on the other side of the world.
I have a question actually here from the audience. I want to put it to you. Is the dual mandate past its sell-by date? The dual mandate refers to the Fed's mandate to deliver full employment and stable prices.
So don't forget the Treasury Secretary was a member of the Fed board until right after World War II. And the Fed certainly monetized the debt during World War II. And so President Truman is the one who separated and triggered what we think of now for the last 80 years of more Fed independence. But here comes Hubert Humphrey, who in 1946 said, we need central planning in America. We want to set goals on employment, goals on inflation. We want to do central planning, just like those guys across the ocean do. Great idea. He worked 30 years to do this. And in 1976 or 7, I can't remember where, he died. And Muriel Humphrey takes his place in the Senate. And in empathy, they passed the Humphrey-Hawkins Act. And leading to this concept of we have a dual mandate of full employment and price stability. But I agree with former board member Kevin in that we need price stability should be the sole mandate of the Fed. Why? Because all those other factors about full employment, you want low unemployment, you want low inflation, that's the fiscal sector, that's the legislative branch and the executive branch influence. And our states influence that far more than controlling prices. So I'm a doubter on the dual mandate. I have a bill I've introduced for 2 Congresses with Byron Donalds from Florida in this Congress to have the sole mandate is price stability.
So I only have 3 minutes left, but I have so much more I want to talk about. But I want to actually fold this question into a question to you, Kevin. With Treasury market dislocation and foreign repatriation of bonds and dollars, what are the risks for Fed and Treasury now to keep market integrity, especially with swap FX structures and trades? I don't know if you saw Jamie Dimon speaking earlier today, but he talked a lot about his concerns about the ability of a market that transacts in the trillions of dollars a day to maintain its integrity. So I'll put that question to you, but I might actually put it a bit more broader and just say, what keeps you up at night? You've lived through a horrible one 15 years ago, and you know better than anybody that there's always something out there lurking. What are the extant risks to our financial system that we need to worry more about?
So what keeps me up at night mostly are red eyes from here back to the East Coast. Otherwise, I sleep pretty well. I've been out of government 12 or 13 years now, so most of the scars from the global financial crisis have healed until guys like Greg bring them up again, and guys like French threaten to drag me back into things. So I'd say the biggest risks that the U.S. have are risks that no one's talking about, almost by definition. If financial markets and households or businesses are really focused on something, the amazing thing about the American spirit is in our own haphazard way, we deal with it. I would just note a couple things. One is we need to keep our eye on the ball. For all of the significant risks that the US economy and the country is facing, I would rather have our cards than anyone else's in the world's by far. George Shultz, who was my mentor at Stanford a million years ago and served under President Reagan, I remember working with him on a little project about something, and he interrupted me. He was a dear colleague of Mike Boskins, who was a friend and mentor and another Hoover fellow. And what George would say is the broad conduct of government policy doesn't have to be perfect. In fact, even in the heyday of the Reagan era, it never was. Government policy just can't be too destructive. And if we can achieve that, the US economy will be in great shape. The problem over the course of the last several years is government policy has been too destructive. Too destructive to banks, too destructive to individual liberty in the post-COVID era, too destructive of technology and innovation. If over the course of the next few years we can just try to arrest most of that destruction, what we used to describe in economics as the micro foundations of macroeconomics, this has nothing to do with the brilliant conduct of monetary policy or fiscal policy. The micro foundations are what matter. And what is that a fancy word for? The culture of this country. The willingness to work hard, take a risk, have it fail, and try again. Everybody, no matter where you're from, there's no stigma associated with your station. You try to make it, and other people don't say, well, you're too big for your britches. This is not an American birthright, but it's why the US economy has chronically outperformed from 1946 until this very day. But if we do harm to those micro foundations, we decide we just want to try to hold on to what we've got. We let some of the things that are most important, like stable prices, eat at the conscience and the integrity of an opportunity society. Well, we're going to be no better off than a lot of these countries with whom we're trading with. That's why this moment is such an important moment. That's why getting policy right at this inflection point, like we haven't seen in 44 years, is huge. And if we do that, the 21st century will be our century. I'm not so worried about the other guys on the other side of the ocean. They're not doing a lot to motivate their technology sector. They are not freeing their people to create and innovate. A lot of them want to come to the US where they can do their best work. If we can focus on what we do best and try to copy someone else's 5-year plan, we're going to be just fine. So while this might seem like a scary moment for a lot of us hanging around government and the private sector, this is the best opportunity we've had, and I have a parochial American view. If the US does well and can get through this inflection point as well as President Reagan did 44 years ago, our allies are going to love us like never before, and our adversaries will be scared of us. The essential thing is that we grow during this period, and if we do, that'll take care of a lot of the problems that are subjecting us and causing us to think that this is a period of malaise.
So we end where we began on the importance and the primacy of economic growth. Thank you, Kevin. Thank you, all of you, Kevin, Faryar, and
Thank you all very much.
Thank you.
Thank you. Great to be with you.
Good remarks. Thank you very much.